Okay, good afternoon, everybody. This is Jim Kinney, and it is a Thursday today, May the 23rd, 2019. Normally, I come to you on Fridays, but I'm going to come to you today, Thursday, because I'm going to be leaving to go to Europe tomorrow. Okay, so by way of introduction, if you're just a new listener, I am Jim Kinney, and I'm a graduate of Boston College. And I've been in the investment arena here for decades, doing live seminars throughout the country and also doing them with the internet on the webinars. Now, I have extensive background in a wide variety of investments, and today I'm going to be going over a little bit about the options and how some of these markets are shaping up. Again, if you are just tuning in for the first time, if you have any questions that come up that you'd like to ask me, just simply use the email address option, OPTION, professor, PROFESSOR, at gmail.com. I am the content provider for the Option Professor. Okay, now, with regards to the markets right now, let's take a look at what's going on. We have got the markets obviously on the defensive big time today. I'll give you a little bit of an overview on what I've been seeing if you're new here. Again, if you have friends or associates that'd like to tune in, just again, give them the website, optionprofessor.com. They get the link and they could join in anytime they like. All right, now, we are down big time today, but it is not exactly a shock to me or anybody who's listening to the broadcast, because I have been outlining some of the reasons why it looked like the market had run its course a little bit on the short-term basis. When we hit 2350 in December, my feeling was that we could snap back towards the 200-day moving average, which was 2750, and it did that, and it did it quickly. When we got up to 2750, I discussed that there was a possibility of going up and retesting the highs at 2950 area. That's exactly what happened as well. Actually made a little bit of a new high. Then up in that area, I tried to bring to your attention that some of the things that I look at looked a little frothy. Like what? Like the put call ratio was up at 85. That's a high reading. The amount of shorts is at the lowest level, according to what I've heard and read, um, since 2006. Now, today, don't forget, past performance is not necessarily indicative of future results, and there is a substantial risk of loss in short-term trading and option trading. So remember to consult your clearing firm, your broker, your financial advisor, and yourself before you consider any type of trading. Now, again, today will be my observations, my opinions, and how I see things. Okay, obviously, there's many different ways to look at things. Again, I reviewed what I thought on the rally up. Now, what made me think that we could be in a frothy area? Well, let's just talk about some of them. We were talking about how the put call ratios were very, very overbought. We were talking about how the short interest was very, very low. We were talking about how the valuations on stocks had gotten a bit rich. We were talking about the GDP report that came out in the first quarter, which everyone thought was great at 3.2%. Pull back the onion, tear back the onion. What's inside? You've got inventory buildup, a lot of it, and that's front running the tariffs. That's not going to be forever, right? Now, the other thing was consumer spending and capital spending, which was not very good. We also have the sugar high from the tax cut wearing off. Again, the tax cut, huge tax cut, 40% of the revenue out the door, and the revenue a lot of it went to buying back their own stock, right? So again, $1 trillion last year, looking for $1 trillion this year. If you want to know who's buying, apparently they're buying back their own stock. With regards to don't fight the tape and don't fight the Fed, right? Well, the tape, again, was very strong. So again, when it's strong, you can't be negative. But when it rolls over, like under 2,900, and then under here 2,850, and then of course if we get under 2,775 and 2,800, then of course you're setting up for a potential acceleration to the downside. My personal opinion is that the transports and the Russell have been telling us this for a while. Let me put up the transport so you can see what I'm looking at and get an idea. All right, transports obviously hit very hard here. You notice they didn't make a new high, right? They don't make a new high here, and then they go down. And we're down another 227. If we start getting underneath 10,000, it's possible that we could see an acceleration to the downside, right? So again, watch this 10,000 area. It's holding on to there for dear life, but it has been telling us lower high, lower high, lower high, taking out that point there, that this has not been the great setup. Again, a caveat on all this is what the tea leaves are showing now, and this is the direction of the market now. Things change, but right now, that's the direction we're looking at. Okay, the other thing I look at is the Russell, right? That's 2,000 stocks. And this is another one that gave me an indicator that we were a little frothy, a little thin air up there, right? Uh, you went up to 1742, right? And then you went way down in December, and then you came back up, and look, 1600, right? Right around 1600, couldn't get through. And now it's holding on for dear life at the 1500. If you get under 1500, you can see that there's not a whole lot underneath it. So I think that going into this weekend, which obviously is a long weekend, maybe they do some short covering tomorrow, maybe. But in the month of June, before they meet, Xi and Trump, at the end of June, there could be more volatility ahead. Okay, so you got to get your seatbelt ready. When we were up at the high points on all this stuff, 2960, and Apple at Apple up at the high point that it was at, which is 220, 210. Google 1300. I was explaining to people that you could do hedging up there, which is trying to stabilize your equity. Try to do something that would offset a very big drop. Like what? Well, it could be something like covered call writing, where you sell an out of the money call when the markets are very high, and then basically you keep the premium if the market goes sideways or goes down. That's a strategy to look into. Again, another one would be the collar. Collars where you sell the out of the money call, you take the premium in, and then you buy a put. That gives you a ceiling on your upside, and it gives you a floor on your downside until the options expire. You could have also done married puts, where you buy a put with some of that big equity you made in that December rally, December through May rally. Take a little bit off the table and buy some puts. And then there's a replacement trade, where you get out of the stock and you replace it with a call option. Limited risk call with a relatively small premium compared to the price of the stock. If the market goes in the tank like it's doing, you lose the premium on the call, but the rest of the money is safe and sound. Now, again, there's a lot of fine print. There's a lot of angles to this stuff, and I don't have in 30 minutes the time to go through it all. So that's why I suggest, if you have positions, if you have ideas, if you have things you'd like to talk about, why you wouldn't send an email to me and ask questions is beyond me. But if you'd like to do it, it's optionprofessor@gmail.com. Okay, so basically that was the story on what we've been seeing, and this deterioration here, again, is not a shock to me by any means. Again, the economy is not going to grow ad infinitum, and unemployment is not going to probably go to zero, and so you're in a situation where it is a situation that you're going to have ebb and flows. Now, what I did this week was I kind of went around the horn, and again, the Treasury market is getting a lot of bids in there. One other thing that gave me a little bit of the overbought condition is the IPOs coming to market, and they've got no earnings, and they're actually losing money, and all of a sudden people are lining up to buy them. That doesn't happen at the bottom. Okay, and how about high yield? We had the tightest spreads in high yield for a while, which means what? The difference between treasuries and high yield, okay, is tight. Now, we don't know what the covenants are on all these things, but I'm sure some of them are a little bit dodgy. And the amount of money in high yield and triple Bs, which is only one grade away from high yield. And again, if triple B goes into double B, those people are going to have to dump those things. That's a big risk looking forward. And the government, we're supposed to be having some kind of surplus late cycle with this kind of growth, and we're running up deficits through the roof. I'm concerned it's going to look a little bit like Atlantic City, where what? You go down to Atlantic City and you build a bunch of casinos on borrowed money, and you build these these beautiful hotels thinking that the revenue is going to be coming. The revenue doesn't show up and you default on the loans, right? Well, I'm not saying they're going to default on treasuries, but it could be dodgy out there for some people, right? And again, the scorecard for the president is the stock market. And if he's going to do anything he can do to get the thing going, then obviously, you got to be concerned about that longer term, because short-term things like dropping interest rates to zero so you can create an asset bubble might not be good for the long-term health of the country. I'm hoping that Powell understands that, because Powell obviously seems to be a little bit challenged by the president. But the mandate of the Fed is supposed to be what? Economic growth and employment and inflation, right? I didn't hear that their mandate was creating massive asset bubbles that will collapse ultimately. So, again, looking for them to go into the quantitative easing near the all-time high on the S&P, and also when it's already gone up 30 or 40% in 2 or 3 years, I think is a little bit wacky, but crazy things can happen. So keep tuned. What I did do also for you guys is I went around the horn to all the different things that are going on in the different sectors. So I'm going to quickly go through these things, and I'm going to show you what I saw. Again, these are my opinions, my views. Everybody's got their own view. Okay, oil's getting whacked today, and it's getting whacked hard. Now, the ETF is XLE that I'm looking at. Can you see it's kind of gapping to the downside? So you got to be concerned that obviously the momentum is turning down, and that momentum can turn from a trot into a gallop. The energy sector on the XLE is 61, and I've got the moving averages 200-day and 50-day. These are ballpark figures, 64 and 66. So you got an inverted to the downside. It tried to get up above 66 here. It failed. Then it came back up to 65, and it failed. So I'd be concerned about this thing unless it can get above 65 and 70. You're not going to get to 75 or 80 unless it does that. And you don't want to fight the tape, and you don't want to fight the Fed, right? So be careful in XLE. With regards to the next one here, is someplace that people may be trying to hang out, and that is the healthcare. It got whacked, right? It got whacked. United Healthcare went down to 208, but it got whacked because everybody thought we're going to socialize medicine or something, and obviously that may not be the case. So in healthcare, the ETF XLV is at 88 and change. The moving averages on it are 88 and 80 and 90. So you can see you want to get above 92, and let the thing get some momentum, and then try to follow the momentum, and then use 86 and a quarter, and then use 85 area as your lines in the sand. But right now it's in the middle. If it breaks under here, it could go right in the soup. The moving averages are above the market. So this thing starts breaking under 86, 85. That's not good for healthcare. Okay. All right. The other thing I'm looking at here is I'm looking at pharma. Now, pharma, a lot of those got whacked very hard because, again, if you miss your test, and your trial doesn't work out, you're going to have trouble. So it's always been a feast or famine kind of deal here, as you can see from the ETF. You go from 170 all the way down to 130, back to 155, then to 145. We're at 146 now. And the moving averages are at 147 and 153. So in my view, this thing's still in the defensive. You get above 155, and I start being more interested. But I don't want to catch a falling knife. And not that this is a falling knife, but it could be if it starts breaking under 145 with any kind of volume. All right, so that's your story on healthcare and my view, my interpretation, my opinion on healthcare and the pharma. Another place I'll give you a couple of places where people seem to be hiding. One is utilities. Obviously, the rates are going down. The 2-year note is down underneath 220, I guess, or right around there, and the 10-year note broke under 240 into the 230 area, and that used to be up at 3 and change here. So obviously, utilities like rates going down because then their dividends look so fabulous, right? So they pay a dividend, pretty good dividend on these things. So you can see from the chart there, this is the Vanguard one. There could be many of them. I'm just showing you an example. 115 up to almost 135, and you're getting paid almost 3% yield right now, and that's where people seem to be hiding, is in the utilities. Another place they seem to be hiding a little bit lately was the REITs. Now, there's some REITs have done very badly, but of course they could be specific to their own properties and their own financials. Overall, the REITs have actually done quite well, as you can see from the chart. They pay a dividend too. So if you're paying good dividends, that might be helpful in this environment. And basically, you can take it from there. So where you are here is you're up near 88, and again, the moving averages on this thing are at 84 and 81. So it could still pull back. Certainly, I wouldn't want this thing under 84. This thing gets under 84, it could be rolling over. So you got to be careful. Okay, but that's another place they seem to be hiding. Where they're not hiding is things like energy, obviously. And let's take a look at the consumer discretionary. Again, this is an ETF on the consumer discretionary. Now, in the consumer, he seems to be buying things at Ross stores. He seems to be buying things at Walmart. He seems to be buying things at Target, but he's definitely not buying them at Kohl's or Nordstrom, it doesn't look like. So obviously, if you got the cheap prices and you got the, the tight spreads, you seem to be getting the customers more. Now, this consumer discretionary looks like it's rolling over. Remember, I told you the first quarter consumer spending was not great. And I don't know, retail sales don't seem to be killing it. So I'd be a little concerned that the consumer might be putting his wallet back in his pocket right now. Again, getting underneath that point here is not a good thing. Now, this is a broad-based ETF. Each company is their own animal. But anyway, I would say that until you get above 180 here, catching a falling knife here doesn't make much sense. You know, when the market's dropping and you like the company or you like the idea, my feeling personally would be that you'd wait for the daily to hit a low and have it surround by higher lows, and then you got a point to defend against, right? Or a weekly low surrounded by higher lows, then you got a point to defend, right? Otherwise, you're catching a falling knife, and you got nothing to defend. What are you defending? You're defending ad infinitum. I mean, every time it makes a lower low, you'd be getting whacked again. So I would like to, if I was to suggest to anybody on all the stuff that you like that's coming down here, wait for some type of a low on a daily, weekly, monthly basis to occur before you go crazy with your checkbook. That would be my suggestion. Learning towards the next thing here would be the industrials. And of course, Boeing and people like that, they've been having their troubles. So obviously this thing has rolled over too. Again, it's breaking down today. We don't know if this is a trot that's going to turn into a sprint. My feeling would be is if the VIX gets above 20 and then 25, and we break under 27.75 on the S&P, that there's possible that a vacuum could go. And, because again, I told you short interest supposedly is at a very, very low point. And the whole world, I mean, they were talking melts up. These big companies were on file on the TV, blah, 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 possible melt up, blah, 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 possible melt up. Well, those people are probably long as long can be. So, there's some selling to be done. And if we start breaking key ranges like we've already done, in my view, on the transports and on the Russell, we could get, a good size move to the downside in the S&P, and that would probably hit most of these companies I'm talking about here, or these sectors anyway. So anyway, on the defensive with regards to Vanguard, excuse me, not Vanguard, the industrial ETF. And again, there's many ETFs, not just this company. This is just an example of one. All right, let's take a look at the financials, because people have been bullish on that since I was in grade school, it seems like. And that's trading at 26.44. So it's on the defensive here. Again, it's breaking down. So if it broke under 25, you could stick a fork in it, I think. But right now, it's still just having a pullback, but we don't know that it's not going to try to keep going. 26.44, and the moving averages are all around 26. So you're in the ballpark of support if this thing can hold this 26 number. But again, you break under 25, and I think that's a problem. The small banks, the regionals, they're not looking quite as good as people thought either. Take a look at the regionals. Regionals rolling over here a little bit, breaking to the downside. It's got a downward slant to it a little bit now. Now, we're at 51 on it. Where are the moving averages on this thing? The moving averages are at 52 and 55. So you break under 49.50 here, and you'll have all the moving averages inverted and pointing to the downside. Not where I want to be. Okay, next thing is going to be on communications. Another place where they're kind of hiding a little bit. I'm looking at the Vanguard communications, and you got the Sprint trying to get together with Mobile, T-Mobile, and you got this 5G coming and all kinds of stuff. But it's on a ledge as well. You're at 85 bucks, And you can see there's kind of a double low there, and there's some highs there. So this 85 is a big area. Where are the moving averages on it? 84 and 82. So you can see if it starts breaking under 85, it could easily blow out some of these moving averages. And there's a bit of a gap here under 70, under 80 in the 79 area. Maybe it's going to try to hit that if it breaks 85. Keep an eye on it. Keep an eye on the volume. You know, the volume during the advance, as I told you before, was very light, meaning if you take a 50-day moving average of the volume and compare it to the 200-day moving average on the volume, on many stocks and indexes, etc., the volume was very light on the rally. And when you have a light volume on the rally and it rolls over, there could be a lot of volume coming out. So you got to be careful because, again, you know, people are not going to just sit there and look at their portfolios dissolve. At some point, they may do something, particularly if it looks like the trade war is going to accelerate, if it looks like there's nothing going to happen in Washington, if it looks like the Fed's not going to cut. You know, these are things that could obviously be wet blankets thrown on this thing. All right. What other sector? How about the materials? Materials. Where are you at on materials? Let's take a look. Vanguard Material. Again, there's many ETFs. I'm just showing you one. Breaking a bit to the downside. Obviously, was going up nicely. Looks like it's rolling over. We're at 116. Moving averages are 121 and 122. So this thing's got a cloud above it, right? I think this 125 mark is a very big resistance zone. You got highs there that should have been holding, didn't hold. You know, once you broke through the highs of 125 on the pullback, should have held, didn't do it. In fact, it didn't even hold 120. So this stuff definitely looks like it's rolling over. And materials, because of deflationary forces, you know, you see copper prices going in the tank again. So again, that's why the rates are moving lower. Doesn't look like inflation. Prices are tanking a bit. And of course, you know, the growth of the economy, if you take out this front running on the inventory buildup, you know, there's some dodgy stuff going on out there. All right. So what else we got is tech. Yes, tech. Now, again, a lot of the companies that I talked about had the same kind of a thing going on. Look at Apple. It went up to 121. It never took out the high 233. Never took that out. And when it went up there, that was on earnings. You know, if you go up on earnings, gap up, and you go right back down, that's not a good sign. That's not a good sign. And that's where you could have collared it, bought some puts, replaced it with some calls. You could have done something because right now you're down to 179 and change, and there's no evidence that that might be the end of it. It could be. Who knows? I'd rather have a hedge going up at 210 or better than be in here now hoping against hope that it's just going to go right back up again. So again, you know, they're not doing the iPhone sales much to report, and they're trying to be a service company, and they've got some tricks up their sleeve, but they weren't very big on specifics, and that's why people are not so optimistic on it right now. Don't forget, we're not going to have earnings till July, right? The second quarter doesn't end till June, so you know there's not a lot of meat on the sandwich coming except this meeting at the end of June, and you know. If this stuff is messy, maybe China and President Trump will, you know, get some humility between both of them and strike a deal. Because I don't think either of them, especially President Trump, you know, this stock market's supposed to be his report card. What we don't need is him to have influence on the Fed, drop interest rates to some ridiculous amount, do QE, create an asset bubble so his scorecard goes to all A's, and then, of course, the debt is up through the roof, and then the next thing you know, there's an event, and now we're coming off of the top of Old Smoky, and there's no buyers, and that's what happened in 2000 and 2008 and 1987, and it can happen again if you are irresponsible with debt and if you're irresponsible with valuations and bubbles. Again, we already got a bubble in the debt market. If you look at the sovereign debt that's underneath zero interest, and if you look at the amount of corporate debt and how much is on the ledge in triple Bs, and then combine it with consumer credit, which has gone through the roof, and if you can combine it with you know, many other factors, I mean, there is a debt bubble out there. I just don't know who's going to light the match and how big the dynamite's going to be when they light the match. But the stage is set because, you know, again, people are buying high yield bonds as if they're buying money market, and you know that's the end of the story. No, I don't know when it's going to be. Could it be next week, next month, 6 months from now? But you know, it's got to have an end to it at some point because you can't just keep borrowing ad infinitum with lousy covenants. And if the economy slows down to a 1 or 1.5% GDP, those corporate bonds are going to come into play. Let's take a look, since I mentioned it. What is high yield doing? Because, you know, what's doing quite well, considering the stock market's coming off so hard. it has been doing quite well. This is the high yield ETF, and you can see it is rolling over. But if it takes out 85, it could be timber, right? Timber, just like it was timber once it broke under 85 last time. You see, this 85 should be where it holds. It held there, right? And it was resistance here for a while, right? Broke, came back up. So 85 is a big number on HYG. You start taking out 85, and they start announcing a second quarter GDP that's not very good. Look at the gap down here. It might be going for that for all we know. Be careful of it here because it looks like it might be rolling over. And again, spreads on high yield are very tight, which means the difference between a treasury and a high yield is not at a tremendous differential, which means possibly that you're not getting paid for the risk you're taking. Okay, let's take a look at a couple of other things here with regards to the sectors that I went through. We're looking at, here's what I wanted to do, the international picture, because a lot of you guys are looking international and think you've got something cooking there. Let's see what you got cooking. So we're going to go to China first. Let's see what they're doing. Trying to give you an overview on what's happening. Try to give you what the moving averages are saying as far as what they're at. Again, moving averages are based on price and time. Price and time do not lie, they're facts. And then of course they give you an idea of where the market has been going because it's on dated material, right? So price has already happened, but they're trying to give you a flow of traffic. And when they start breaking, I get a little concerned. And if they get inverted, sometimes you can get very concerned. If they get way away from the moving average, like Boeing got up to 446 and the moving average was 355, sometimes they come back in. Or Amazon got up to 2050. The moving average was 1500. Come way back in. So I like to do moving averages to try to determine overbought, oversold. All right, now let's take a look at China. What's going on here? Let's go. All right, had a big run up just like we did, rolling over just like we did. Okay, it's at 39.96, and the moving averages are 43 and 41. So they haven't reverted back down, but I think this thing might have a hard time getting above 44. If it got above 44 and 46, that opens the door for the thing to get going. One of the big companies in China, of course, is Alibaba, and they have everything going 9 million ways to make money, and on a long-term basis might be a good company. So this might be something to keep an eye on during the pullback. Obviously 130 was the low, had a big run up to 190, and then bam, back down. See, this 200 area is a rough racket, a gap there. So again, you can't get above 200. You obviously can't get to those big numbers. All right, let's see what else is happening here around the world. Brazil, they got a new president, supposed to be a tough guy out of the military or something like that. Had a big run up. Now it's on the defensive. You're at 39 bucks about. Where the moving averages? The moving averages are at 40 and 39. So they're right here at 40. For me to be interested, getting above 40 and 42, then I think it could be getting back on the bicycle. If you go under and take out this number here, those moving averages invert, then the bloom may have come off the rose on Brazil. So be careful unless we're trading above 40, 42 area. Okay, I got a few minutes here. Let's go to India. They got the Modi, and Modi is getting elected. Everybody loves Modi. All right, so how's India doing, though? Well, it's hanging in there, but it did gap up, and it didn't take out the highs of 36. This thing goes down to 34 and breaks 33. I would be very concerned about India. Right now, it does look like it's trying to get moving, but those highs are still ominous right there. And the moving averages are 34 and 33. So if it closes down to 34 and holds, that would be okay. But if it closes 34 and breaks 33, that wouldn't be so okay. So keep an eye on India, and certainly above 36, I'd be a lot more interested in it. Turning towards South Korea. I just wanted to show you how Asia is doing over there. Their GDP, I think, has gone negative. Look at you. You're at 75 bucks, then you're at 65 bucks, and now you're at 55 bucks. So they're definitely liquidating South Korea. That's for sure. As far as lately. Okay, so the trend on that certainly doesn't look very good. Moving average on those, are above the market, as you would imagine. One that looks interesting to me is Argentina. Obviously, they've got nothing but volatile headlines coming out of there. So obviously, it's a crapshoot from that standpoint. But the chart is starting to look a little bit better, and some people are telling me that it's a place to keep an eye on. And you can see, it had a big drop. and now it's turning around. It went to 21, and then it went up to 28, came back down at 26, now back at 28. Moving averages are 27 and 26, and I think if you can clear 30 here, it might be something that could gain some momentum. So you can see if you can get above 30 here, it opens up the door quite a bit. So again, right now it's in a trading range 25-30, and if you start breaking out to the upside, I'd keep an eye on it, particularly with the moving averages underneath the market. Clearly, your line in the sand should be that 25 mark. It looks pretty much like, that's the 52-week low, and as long as it's above that and it can break 30, Argentina might have something cooking. Things change, and you got to be careful of that. You go with the flow. Again, don't fight the tape and don't fight the Fed. Again, interest rates have come down here today. Yields have dropped a bit. So again, some people think the 10-year might be on the low end going to 220, 225. And some people think the high end is 260 to 275. That seems to be the range right now that people believe that the interest rates may operate between each other. What Chairman Powell will do under the proper influences, I don't know. And of course, the winds of change could be happening at any time. In review, I would like to say this. If you have any questions on something that you'd like to talk to me about, shoot me an email, optionprofessor@gmail.com. OPTION, professor@gmail.com. And again, tell your friends and associates, and hopefully you'll be coming back. I'll be back with you on Friday. I believe it's June the 7th. Okay, so we're got a Memorial Day this weekend. Let's all have some good fun. I'm going to be going to Europe. I'll be back to speak to you again on June the 7th. Again, I'm Jim Kenny, and it's good to be talking to you today. Again, don't hesitate to shoot me an email, and have a safe, healthy Memorial Day, and watch the numbers. And again, if you have any questions on how to hedge or what hedging's all about, please give me a call. All right, I'm signing off now. Thanks for listening. Thanks for being with us. And again, I'm back with you on June 7th. Until then, have questions, shoot me an email. Good day now.